Welcome back to the deep dive. Today, we're going to do something a little bit different. We're going to look at a document that, well, quite frankly, usually ends up buried deep in some PDF archive where sunlight never touches.
You're talking about an examiner's report.
An examiner's report, yeah.
It sounds incredibly dry, doesn't it? The ACCA Advanced Audit and Assurance Examiner's Report from late 2025. It sounds like something you'd read to, I don't know, cure insomnia.
Exactly. But here's the hook, and this is why I really wanted to pull this for our deep dive today. When I started reading it, I realized it's not really about accounting rules.
No, it's not.
It's more like a psychological autopsy. It's a breakdown of how incredibly smart people who've studied for years, just completely miss the point when faced with the real world.
That is a perfect way to frame it.
Yeah.
This report is basically a catalog of what happens when textbook theory crashes headfirst into commercial reality. And the casualties are, well, they're fascinating.
The examiners call it a lack of commercial acumen, which is just a very polite way of saying, you know the definitions, but you have no idea how business actually works.
Precisely. And what we have here are three really specific business scenarios: Mistral Co., Kerr Co., and Phoenix Co., where candidates just walked right into these traps because they were thinking like students taking a test.
Not like professionals doing a job.
Exactly.
So our mission today is to dissect these three cases. We want to figure out how you can spot the difference between, say, a technical error like a typo and a fundamental failure of logic, because the examiners weren't angry about typos.
No, they were not. They were angry about people checking their brains at the door.
Okay.
And some of the examples are, I mean, truly cringeworthy.
Let's jump into the first case then, which I found, I have to say, the most visually funny. Mistral Co.
Mistral Co. So let's set the scene. This is a listed entity, big company, big money. They operate in the renewable energy sector, and they're manufacturing these massive wind turbines called Zephyrs.
Right. And you really need to visualize this. These aren't little windmills in a field. These are industrial giants. They're installed offshore in really remote locations. It's a heavy, complex industry.
And the company is in trouble. The scenario outlines that they're facing, technical failures with their tech, costs are rising, the market's getting tough. It is a high-risk environment.
So candidates are asked to evaluate the risks, maybe offer some thoughts on the business systems, and this is where we get the just-in-time blunder.
Ah, yes. The just-in-time blunder.
So for those who don't spend their lives in supply chain management, just-in-time, or JIT, is a system where you don't really hold inventory. Parts arrive exactly when you need them.
Toyota made it famous. It's incredibly efficient. They have a ton of money on warehousing.
Right. It's a fantastic system for high-volume, standardized production in, stable environments.
So looking at Mistral Co., a significant number of candidates said, hey, Mistral has high storage costs. They should switch to a just-in-time inventory system to save money.
Which, if you think about the physical reality of a wind turbine for even 5 seconds...
was absolute madness.
Why can't I just Amazon Prime a 200-foot turbine blade?
Because the supply chain for these things is global, it's slow, and it's incredibly fragile. You're shipping massive components from overseas, you're dealing with customs, weather delays, specialized heavy transport. If you try to run just in time and one ship gets stuck in a canal,
and whole factories stop.
The factory stops. But it's worse than that. In this industry, contracts have these strict penalty clauses. If you don't deliver that turbine by the installation date, you are paying millions in damages. You simply cannot risk a stock out.
You need a buffer.
You need a buffer stock. The students were just applying this generic business school concept, JIT is efficient, without looking at the actual product.
So they were reciting a definition instead of looking at the business.
Exactly. But there's a second layer to this failure that the examiners really honed in on. Even if JIT was a good idea, why are the auditors suggesting it?
Right. They're not management consultants.
Exactly. An auditor's job isn't to fix the business model. The auditor's job is to assess the risks of the current model. A good answer would have been something like, given the long lead times for components, is there a risk that Mistral runs out of stock, delays production, and breaches its contracts?
I see. So instead of saying change your system, you say, does your current system create a liability we need to account for?
That is the difference between an amateur giving advice and a professional assessing risk.
Speaking of assessing risk, we have to talk about the math error, because this one hurts my soul a little bit.
The materiality calculation.
So just to catch everyone up, materiality is basically the threshold for caring. If a mistake in the accounts is smaller than this number, we ignore it. If it's bigger, we fix it. And you usually take a percentage of revenue, say 0.5%.
Right. It's how you prioritize your work.
Mistral Co.'s revenue was listed as $4,762 million.
Oh, nearly $5 billion.
A massive company. And the report says a shocking number of candidates punched this into their calculators as 4.7 million. They just dropped 3 zeros.
They treated a multinational listed giant like it was a local car wash.
And the result was they set a materiality threshold of roughly $20,000.
$20,000 for a company with $5 billion in revenue.
So why is that such a disaster? I mean, isn't checking more stuff better?
No, it's paralyzing.
Yeah.
If your threshold is $20,000 on a $5 billion audit, you're going to be auditing the coffee budget. You're going to be checking every single taxi receipt.
You'll drown in data.
You'll drown in it, and you'll never finish the audit. And worse, you'll miss the big risks because you're too busy looking at all the tiny stuff.
But the examiners weren't just mad about the bad math. I mean, everyone hits the wrong button sometimes. They were mad about the sense check.
That is the key term, the sense check. If you are a professional and you look at your calculator, it says 20,000 for a global manufacturer, a huge red light should go off in your brain. You just look at that number and just go, that is impossible.
It's the ability to step back and ask, does this even make sense?
Exactly. The fact that candidates wrote that number down and just moved on proves they weren't thinking about the entity. They were just robots processing data. And in audit, if you're a robot, you are dangerous.
That robotic thinking leads us perfectly into the Zephyr problem. This was the real technical heart of the Mistral case.
Yeah, this is where we get into asset valuation. So Mistral has the Zephyr 1 turbine. It's failing. It's a disaster. But they're developing the Zephyr 2.
And they have spent $550 million developing the Zephyr 2. They've capitalized it, meaning they've put that $550 million on the balance sheet as an asset, claiming it's going to make them rich in the future.
Right. And the auditor has to verify that asset. Is it really worth $550 million?
And the students went straight to the invoices. Check the receipts. Check the timesheets. Did they actually spend the money?
Which is part of the job, yes. You need to know the cost was incurred. But they completely missed the elephant in the room.
The Zephyr 1 doesn't work.
Exactly. The Zephyr 2 is an evolution of the Zephyr 1 technology. If the underlying technology is fundamentally flawed,
then the Zephyr 2 probably doesn't work either.
And if it doesn't work, it's not an asset, it's a loss. That $550 million is worth zero. The candidates were so busy checking if the money was spent that they forgot to ask if the money was wasted.
That is a profound distinction. You can have a perfectly documented pile of garbage.
Exactly. The best candidates connected those dots. They said, I don't care about the timesheets yet. I want to see the technical feasibility studies. Prove to me that Zephyr 2 has fixed the problems of Zephyr 1.
It's looking past the paper trail to the physical reality of the machine.
That is commercial acumen in a nutshell.
Okay, let's leave Mistral behind and move to the second case, Curco. This one's interesting because the rules of the game change. We aren't doing an audit anymore.
No, this is a due diligence assignment.
So set the stage for us. How is that different?
Well, in an audit, you're looking at a company's past their financial statements, and you're telling the shareholders, yes, this is true and fair.
Okay.
In due diligence, you're working for a buyer. Curco wants to buy another company, Brightco, and they hire you to investigate Brightco to see if it's a good deal or if it's a trap.
So the mindset shifts from, is this compliant, to, is this a ripoff?
Exactly. And the candidates struggled mightily with that shift. The big trap here was the warranty.
Right. Brightco, the company they're looking to buy, manufactures cars, and they offer a massive 7-year warranty.
It was a huge selling point for customers. But for the company, that's a massive future liability.
So the candidates see warranty, and their brains go straight to the textbooks. They start arguing about IFRS 15, the revenue standard. They're debating accounting treatments. Is it a separate performance obligation? How do we allocate the price?
Obsessing over how to label it in the accounts.
But if I'm the buyer, if I'm Curco, do I really care about the label?
Not really. You care about the cash. You are about to buy this company. A 7-year warranty means that for the next 7 years, when those cars break down, you have to pay to fix them.
So the risk isn't about accounting compliance. The risk is that the liability is just plain wrong. It's undervalued.
Correct. The risk is that Brightco has deliberately underestimated the cost of those future repairs to make their current profits look higher, so they can sell the company to you for a higher price.
Dressing up the bride.
Exactly.
Yeah.
The auditor asks, did you follow the rules? The due diligence professional asks, are you lying to me about the value? The candidates miss the valuation risk because they were stuck in that compliance mode.
There was another detail in the Kerr case that I found hilarious. It was about the timeline. The scenario said Kerr Co. had a 4-week exclusivity window to finish the deal.
And the candidates panicked. They saw 4 weeks and immediately started writing about fraud.
It's too short. It has to be suspicious. They're rushing us because it's a Ponzi scheme.
It just reveals a total lack of experience with how M&A mergers and acquisitions actually works. In the real world, deals happen fast. Time kills deals.
Sure.
An exclusivity period is always tight. 4 weeks is aggressive, yeah, but it's standard commercial pressure. It is not a crime scene.
So the students took a standard business constraint and interpreted it as some kind of criminal conspiracy.
They defaulted to extreme skepticism. Now, skepticism is good for an auditor, but it has to be calibrated. If you walk into a deal room and accuse everyone of fraud just because they have a deadline, you're not going to last very long.
So you're going to get kicked out of the room.
And you should be. The job is to prioritize the key risks in the time you have, not to call the police.
It really seems like there's this recurring theme where candidates are looking for the trick in the exam question instead of just analyzing the business situation as it stands.
That is a very fair assessment. They're gaming the exam, not playing the role.
Let's move to the third and final case, Phoenix Co. This one gets into the interpersonal stuff. Ethics.
Right. Phoenix Co. is a digital media streaming service. This scenario takes place at the very end of the audit.
The audit is done, but the finance director, the FD of Phoenix, comes to the audit partner. He's new, he's inexperienced, and he says, look, I have this terrifying meeting with the bank to negotiate our funding. I don't want to mess it up. Can you come with me? Just to, hold my hand and answer any technical questions.
It sounds so human, doesn't it? Help a client out.
It does. It feels like good customer service. But the examiner's report just screams, no.
It is a massive trap. And the candidates needed to identify 2 specific threats here. The first, and the most dangerous, is the advocacy threat.
Walk us through that.
If the auditor walks into that bank meeting with a client to help them get a loan, the auditor essentially becomes a cheerleader. You're advocating for the client's financial health.
You're on their team.
You're on their team. And here's the nightmare scenario. The bank looks at you, the trusted independent auditor, and thinks, well, if they're here, everything must be fine. They give the loan. 6 months later, Phoenix Q goes bust.
And the bank sues you.
They sue you. They say you were there. You supported them. By advocating for the client, you lose your independence. You can't be the objective referee anymore because you've put on a team jersey.
That makes perfect sense. What was the second threat?
The familiarity threat. This new FD is trying to bond with the partner. I'm new. Help me out. If you say yes, you shift that dynamic. You become his crutch.
And then next year, when you find a mistake in his accounts,
it's much, much harder to be tough on him. Come on, we're buddies. Remember how I helped you with the bank? You can't audit someone effectively if you're too close to them.
Okay, staying with Phoenix Co., there was a technical point about the auditor's report that I think is really important for understanding what auditors actually do. It was about key audit matters, or CAMs.
Yes. CAMs are the section of the report where auditors highlight the most significant risks they found. It's the scary stuff.
In the scenario, the audit partner was rotating off the engagement. The rules say partners have to change every few years. A lot of candidates said, this partner rotation is a key audit matter. We have to put it in the report.
Which is just wrong. And it's wrong for a very specific reason. A key audit matter must be a matter of significant auditor judgment.
Judgment, that's the key word.
Right. Valuing those Zephyr turbines back at Mistral, that's judgment. That's messy. That is a CAM partner rotation. That's just a rule. It's a fact. It happens on a schedule. There's no judgment involved.
So putting it in the CAM section just shows you don't understand the purpose of the report. You're mixing up administrative trivia with critical financial risks.
Exactly. It belongs in a governance note, sure, but it is not a key audit matter.
We've covered the 3 cases, but I wanted to zoom out for a minute. The examiner's report had this section where they just vented their frustration about generic answers.
The generic answer plague. This is the #1 complaint from examiners every single year.
They gave this example that apparently drives them crazy. Students just writing the phrase, review board minutes.
It is the classic filler answer. It means nothing. If you write review board minutes on a real audit file, your manager will look at you and scream, for what?
So if I'm auditing Mistral, the wind turbine company, and I just write review board minutes, I get 0 points.
0. But if you write Review board minutes to identify discussions regarding the failure of the Zephyr 1 turbine and any board decisions to abandon the project. Now you have a mark.
Because you've tied the action to the specific risk in that specific scenario.
Context is everything. The report actually breaks this down into a really useful chain of thought for anyone trying to analyze a business problem. It's the so what test.
I love the so what test. Walk us through it.
Okay, so stage 1 is the fact. Raw material costs are rising. Most students stop there. They think they've identified the issue.
Right.
But the examiner asks, so what? Stage 2 is the impact. Profit margins are squeezed. Better, but still not quite there.
So what's the final step?
Stage 3 is the implication. This potentially creates onerous contracts where the cost to fulfill the contract is higher than the revenue, requiring an immediate provision in the accounts.
Boom. That's a money shot.
That is the money shot. You took a macroeconomic fact inflation and you traced it all the way down to a specific line item on the balance sheet. That is what a professional does.
It really highlights that knowledge is completely useless without application. The failing candidates probably knew the definition of an onerous contract. They could write it on a blackboard.
They couldn't see one in the wild. They treat the exam as a memory test. They see the word inventory and they robotically count the stock instead of pausing and asking, is this inventory perishable? Is it obsolete? Is it gold bars or is it bananas?
Because you audit gold bars very differently than you audit bananas.
You certainly do. One rots, the other gets stolen. The risk profile is totally different. If you treat them the same, you fail.
Before we wrap up, there's one final thing from the Mistral case that I want to touch on. The examiners dropped a bit of a bombshell warning about sustainability reports.
This was a very forward-looking point. The scenario mentioned that the audit committee asked the firm to help prepare the sustainability report. Calculating carbon footprints, social impact metrics, that sort of thing.
And the risk is that the firm might then be asked to audit that same report later on.
It's the ultimate self-review threat. You cannot be the author and the critic. But the examiners are flagging this because as the business world moves toward ESG, environmental, social, and governance reporting, these lines are getting very, very blurry.
It's not like double entry bookkeeping where everything balances to zero. Carbon accounting is messy. There are a lot of estimations.
Exactly. And clients are desperate for help with these new metrics. They'll pressure their auditors. Just help us figure out the numbers. You guys are good at math. And if you say yes, you've compromised your independence before you've even started. You end up auditing your own homework.
It's a fascinating place to leave it. As the scope of what an auditor does expands beyond just money and into impact, the traps are going to get harder and harder to spot.
Absolutely. The takeaway for anyone listening, whether you're an auditor, an investor, or just someone navigating the corporate world, is to look past the label. Don't just look at the rule. Look at the reality. Look at the turbine. Look at the warranty liability. Look at the relationship with the client.
And always ask, so what?
Always ask, so what?
I love that. Well, that brings us to the end of our deep dive into the 2025 Examiner's Report. A surprisingly thrilling tour through the psychology of failure.
And a harsh reminder to always check your zeros when you're dealing with billions.
Indeed. Please check your zeros. Thanks for listening, everyone. Take a look at your own work this week, whatever your field, and ask yourself, am I just reciting the rules or am I seeing the commercial reality? We'll see you on the next deep dive.